Welcome to Ask the Experts. I'm Jill Schlesinger, editor-at-large of CBS MoneyWatch. I'm joined by
Jack Otter, executive editor of CBS MoneyWatch.
This is so exciting. We've got a lot of news in the headlines today. We are going to be talking about housing with our housing expert, Ilyce Glink. We're going to bring her in just a moment. But Jack, the Facebook IPO, it just won't die.
I really wish it would. My wife looked at me this morning and as it was blaring on CNBC and said, when will this go away?
Yeah, I'm thinking probably another week or so that that it stays in, but maybe not top of the fold kind of stuff. Because when it's the top right story in the New York Times for a few days in a row, it is a little bit daunting, isn't it?
It is. And the funny thing is, I actually sent a note to the editor-in-chief of Barron's yesterday praising him because, granted, things have moved since Saturday, but I don't know if you noticed, it was a one-page story in Barron's. And a tiny headline. And I said that was about what it deserved. But it has become this monster. And in a way, I think it's been obscuring more important stuff in the market.
I absolutely agree. Let's just give a quick recap about what the fuss is about right now, because essentially there are a lot of lawsuits flying. A lot of regulatory involvement. Even the AG from Massachusetts, who I'm sure has political aspirations, he's like, let me just look at this Elliot Spitzer guy. So he is like a tough AG and he becomes governor. Now, as long as he doesn't sleep with a prostitute, he's in good shape.
Keep his socks off or on or whatever.
He does. So what is happened right now is that there are some allegations that, number one, Facebook maybe has disclosed information to certain analysts, but not to all analysts. It may have tapped their underwriters, analysts on the shoulder and said, hey, you guys, you might want to revise down some of these numbers. But then talk about what happened with the analysts in that next stage. Once they had the information, they had the amended S-1 filing with the Securities and Exchange Commission. What happened at that point that's gotten everyone freaked out?
Sure. First, we should make clear that the information that it was possible that Facebook's revenue growth could slow as more people migrated to mobile, and like a lot of people, Facebook hasn't quite figured out how to monetize mobile. That was disclosed publicly, as it's supposed to be, in Facebook's S-1 filing with the SEC. Not something everybody reads, but the fact is it's out there, they did it right. Now, it was a little bit weird to amend your S-1 that close to an IPO. I think that's quite unusual.
And I think that's why the Facebook CFO is coming under pressure right now.
Yeah. So there was that's the first weirdness. So the second weirdness is that Morgan Stanley, and I believe there's talk that some of the other underwriters as well.
Right, Goldman and JP Morgan Chase.
All suddenly changed their forecasts. Now, Henry Blodgett says in his experience, the only reason they would do that would be if they got a wink or something from Facebook saying, hey, guys, you ought to take a look at this. It's too much of a coincidence that everybody would change their estimates at one time. So that's question number one. Question number two is, okay, once they revised their estimates downward, what did, say, the Morgan Stanley analyst, is it David... I've actually forgotten his name, forgive me, but what did he do with that information? Did he just give it to institutional clients? He might have, and you know what? That might be okay.
Well, it's actually legal to talk. They say you have to have verbal communication only, not written communication. You cannot be issuing a research report until 40 days passes after the IPO. So it is legal for them to have verbal communication with clients. That's what I know so far.
And you and I have actually laughed about this because, of course, the opposite issue was a problem in the dot-com bubble, where the analysts at these big investment banks were totally in the pocket of the underwriters. That's why Henry Blodgett got in trouble for touting stocks that the bank was underwriting, even when privately they were saying they were terrible. Now we've got the opposite situation. Here we've got an analyst saying, you know, this ain't so great, while the underwriters are still touting it.
So it's going to be interesting. I think that the story's yet to be written. I understand that, you know, again, as lawsuits are flying and regulators begin investigations, it's a long road. We don't know a lot right now. And we also don't know whether anyone broke the law. So I hate to rush to judgment. I've certainly been... I don't know. I've been getting a lot of questions when I do hits, as you have with radio and TV, that people are like, so they're all going to go to jail, right? And it's really not that level right now.
Right. Absolutely not. And you know, I hate to say this, but part of me likes to say it because I want to drive the point home. I was thinking before I came on today, how many people on CBS MoneyWatch in the days and weeks leading up to this IPO warned our readers not to buy. And I was thinking, Jill did it. I did it. Konstantin von Hoffman did it. Eric Sherman did it. Alan Roth did it. Larry Swedrow did it. It was just, we kept on beating that drum. Do not buy this IPO. And you and I were saying it to our friends and family and people in the newsroom. And we didn't know that this was going to happen, but we did know that these things often don't go the way of the individual investor. I thought the problem would be different. I thought people wouldn't be able to buy until 60, and then it would go down from there, and it would be at 50 today, not 30.
Well, okay, and so what did Facebook do today? Facebook actually green arrow. Unbelievable. It was up $1. Facebook closed at $32 a share, so $6 off the IPO price. It was up 3%. Again, don't close the door on Facebook just yet. I mean, it has I believe it will have a long history. These first early days, you know, if something went wrong, they'll be punished and the underwriters will be punished. But there's a lot more to be said about this company in the future.
And what's funny is, of course, none of this has anything to do really with Facebook's actual valuation. I mean, if anything, oh my gosh, they let the truth slip that 100 times earnings might be a little pricey for a company with slowing growth. But again, that's actual. That's what people should be thinking about in this case, not what sort of an artificial pop are we going to get on day one of trading.
That's right. And, well, let's just talk a little bit about how the market in general seems to be taking our eyes off the ball, which is events in Europe are far more dangerous and impactful to this economy as well as to the world economy and markets and your retirement accounts
right.
than Facebook. So we've got a big problem because we've got mixed markets today, which, by the way, was a miracle because I thought the market was about to be down 250 points by the end of the day. We actually closed with the Dow down just 6.5 points at 12,496. The NASDAQ is up 11 at 2850. And miracle of miracle, S&P 500 squeezes out a 2.25 point gain at 1318. But Jack, things in Greece are tenuous at best.
Yeah, and obviously Greek problems are not news to the market, so that has been priced in to a certain extent. But now it's kind of like all bets are off. Does Greece completely collapse? Nobody knows. I mean, we don't even have a government in place to predict what's going to happen. So I do think that a lot of this is priced into the market, but it's tough to price in contagion. What happens if there is a Greek collapse, if it brings down a big bank in Europe and you have a Lehman-like moment? I don't think anybody can really, predict that.
Stay tuned. It's going to be so exciting. I have some good news. Oil prices are down big. In fact, crude oil dropped just under $2. We settled under $89.90. I am on the CME website as we speak. $89.90 a barrel. This is phenomenal. We were just at 110 5 seconds ago. So,
and also, let's pause to think about where we are in the calendar right now. Just before Memorial Day.
Amazing.
That's when gas prices are supposed to spike.
Right. And so what we know right now, according to AAA, gas prices nationally, $3.68. Sounds a lot better than that near $4. Did everyone just overdo it on the upside? Well, $5 gas, because, I know that it's hard to believe that media people overdo it, but seems to be a lot of teeth gnashing around this.
Well, sure. And I think, there's all this talk of speculators driving the price up. Well, now speculators are driving the price down. I think it's, everyone thinks it's a conspiracy when it goes up and then it's natural when it goes down. I think it's very simple. It's global growth. We had those nice numbers for employment early in the year, and then, of course, those started to taper down, and then we had the European problem. So I think traders are just looking at, China could be slowing, Europe could be slow. Europe is slowing, so maybe we ought to take down the price a little bit.
And another piece of good news, and for this we will bring in our fabulous guest, Ilyce Glink. I like to give you the R, Ilyce. Ilyce is an award-winning, nationally syndicated columnist. She's a best-selling book author. She writes a blog here at MoneyWatch called Home Equity. Is that right?
Home Equity,
okay,
yep.
I had a little bit of a moment here. Sally, when I put that up, she writes about all these awesome things. She owns about 100,000 websites. I'm a little bit exaggerating there.
Just a little.
Thank you. And, what is totally amazing, Ilyce, is that you've been on this show now for a couple years. Every so often we haul out the expert when it comes to anything housing related. And for so long, what I remember is that you were like, look, this stuff's not getting better. Just relax. But the last time you were on, you did have almost a little spring in your step, young lady. And I would say that according to this week's data and general consensus, even among a lot of housing bears, Ilyce, it looks like we are in a bottoming process. Is that your view today?
Yeah, it is actually. I think I was here maybe 2, 3 months ago and we talked about it, and you were like, wait, is that a hint of optimism that I hear coming out of your mouth after 5 long years? And yeah, I felt that this year was going to be a turnaround year for us. And everybody, when you say that, the expectation is, wow, stock market like today, it's down 180 points and suddenly it's eking out a gain at the end of the day. Not the real estate market, but we are seeing some markets do very, very well. Texas is starting to look good. Washington, D.C. has been very strong. We're seeing Portland, which has had a very, very tough time of it, start to turn around a little bit. Miami, there's some good news out of Miami for the first time in a very long time. The coasts of California are starting to firm up, not the interior of the state, but the coast is looking nice. So there are some bright spots. And then the overall number today, which was that the average home price is up about 10%. I don't want anybody to get so excited about that yet. What we're seeing there is really a shifting of what is selling. And that's where the good news is, I think. Instead of so much distressed property, foreclosure, short sales at the very bottom of the market, we're seeing more fairly priced homes, non-distressed sales, and that is pushing the price up a little bit. So there is some good news there.
And I also noticed that when I was looking at the new home sales report this morning, I just wrote this down to remind myself, sales up 25% from the low. I mean, the low is pretty low, so let's be honest.
The low is the worst number in history.
Right? But
I build more houses myself.
Right. Up is up. I think that what Ilyce is saying, though, is so important, Jack, which is this is not an equity market. This is not going to have a V-shaped recovery. You've said this over and over. Some people think that housing is going to get to that 1.2 million rate we saw in 2004, 2005. How's that going to happen?
Yeah. Well, here's how it would happen. It would happen if the economy improves and the household formation that has been on hold for so long, and we've talked about kids staying home with their parents, immigrants, the immigration of this country is actually slowing down and immigrants are not forming new households. So I guess if the rubber band kind of gets pulled back far enough for long enough, then you could get a sharp bounce back. But still, real estate is not like stocks. It fell more slowly. It was painful, but much more slow. And it'll be a more slow, gradual climb, especially because I don't think that we're going to see that sort of frenzy. Gosh, I hope not.
Yeah.
That frenzy of the bubble years anytime soon.
And also, of course, with 12.5 million people, 13 million people out of work, it's hard to see a lot of new house sales, popping up here.
And interest rates may very well go up with an economic improvement, and that's going to make housing more expensive the way that actually most people measure. Instead of looking at the sticker price on a house, they look at the monthly nut, and if interest rates go up, that's going to go up too.
Ilyce, I just want to say one thing here. Before we get to all these questions, I will point out another very shaky indicator, but let's call it the MoneyWatch Ask the Experts indicator. You know that we've been answering questions about real estate for however long we've been in business here, over 3 years. And this is so interesting. We used to be flooded with questions from people who were underwater or in foreclosure. Today, we have got a ton of questions from people who are looking to invest in real estate and make money. Ilyce, tell us a little bit about that trend.
Well, it's really interesting. So one of the things that we're seeing is that at the very, very bottom, homes are being scooped up out of foreclosure and short sale. The banks have decided that it is time now to get moving on the short sale. Once they had the $26 billion foreclosure settlement that earlier this year, the processes have been cleared out, the doors have been open, and so the banks are in a rush to process through the remaining 2, 3, 4 million homes that could go into foreclosure, are in short sale, want to be in short sale. And so what you're seeing is them getting very reasonable on price points, and people are starting to dive in big time. And I think they're hearing the message that mortgage interest rates this week again fell to a new record low. We're seeing the numbers, prices, affordability. It's never been this good. Like 50 years, it's never been this good relative to income. So Jack's exactly right. Get a few more people employed, and we're going to have a real hot market on our hands.
And
well, sort of.
Right, exactly. All right, we'll take lukewarm for God's sakes. We have Chris in our chat room who wants to know what are the current inventory levels on bank-owned properties that are not yet up for sale? Do we have a real number there or not really?
I don't think we have a real number, but I would say that the numbers that I'm hearing are somewhere in the $1 to $3 million pile. Not $1 million, $1 to $3 million home pile. So the shadow inventory, this number of homes that could go through foreclosure or short sale, somewhere 1 to 3 million. It's a significant number. There are about 15 million Americans who are underwater to some extent in this country. And if any number of them stop paying on their mortgages, that number could skyrocket.
But conversely, Jack, if the market firms up a little bit and we get some better appraisals, we also have a lot of people who have mortgages that are above 5% who could be great refi possibilities if they could only have that 20% equity. So Dick in our chat room just asks, is it time to refinance even if I did it last year? Jack, I'm going to ask you that question because I think that might ring true to someone like you.
Yeah, it's absurd. My only problem with that is that you could keep on extending that 30-year mortgage. You go 30 down to 28, back to 30. So there's a danger there. But from a purely interest rate standpoint, yeah, now it's, if you've got good credit, you've got that nice loan to value ratio. It's 3.8, 3.9, depending. I was offered on a co-op, I was offered a 4% with 0 closing costs.
That's
alternatively
awesome.
about 3.86 with closing costs. So yeah, it's actually a good deal. And then maybe what you want to do, depending on your age, is pay an extra year. Make an extra payment each year to turn that 30 years, say, to a 23. I think it is. Ilyce can correct me on that.
And there's a great website that we've had one of the guys from hsh.com. They've got a really nice refinance calculator. And what you're really trying to figure out is, how long are you staying in this house, what you're paying now, what you'll be paying in the future, how you can recoup all of that money. And as you said, you do have to actually run the numbers. And Ilyce, I know you're a big fan of slicing years off the life of a mortgage, right?
I am. So in our case, we refinanced a year ago, 3.25% on a 15-year, paid nothing, no closing costs. I think our total amount out of pocket was about $495. I just asked one of my favorite mortgage lenders if we should refinance again, and he said, no, the 15 years aren't really moving. I mean, where are they going to move? Let's be honest. Now, I did see that there's a 5-1, so fixed for 5 years, then it adjusts on an annual basis, but it can only go up 1 point a year. That's at 2.86%.
Gosh.
So clearly somebody is giving that lender money to give you that kind of a loan. But if you are in a position where in 5, 6, 7 years you're going to be out of the box, that's a really good loan for you because you're not really paying any costs. You're fixed for 5 years at 2.86%. And then even if it goes up the maximum the next 2 years after that, you're still only paying 4.86%. That's gotten you 7 years down the road. Now, for me, I still kept paying the same amount. My 15 years now down to about 11.75 years.
All right.
I wish I could just stretch it out for a million years because where am I going to find 3.25% money anymore? But so it goes.
All right. Well, Jason in the chat room wants to know, will Facebook's millionaires and billionaires crush my dream to find a nice home at a decent price in the Bay Area? Ilyce, the Bay Area is quirky, huh?
I've been in the Bay Area at least once a month this year. I've been going out there and driving around. It's out of my price range already. You turn around and 30 seconds later, it's gone up another $500,000. Palo Alto, which is where I went to dinner a couple of weeks ago. Oh my goodness, I think they're going to start charging just to drive on the streets pretty soon. So
my friend claims that she is the poorest person in Palo Alto, and she has this teeny tiny house on a spit of land, and it was just appraised at $1.2 million. She goes, I am the poorest person in Palo Alto. It's impossible.
But I was there. It was a while ago when I was there, but I was staying at a hotel when the glide path for the airport was visible out the window, and it would be a Southwest jet and then a private jet of the same size.
Oh my gosh.
Then a Southwest jet and then another private 737 would come in. It's
all
really
right,
crazy.
so Jason's going to have to rent and maybe move to Oakland. You're not going to be, move a far afield, right?
Oakland is lovely. So my cousins are living in Oakland, and their house at the height of the market was appraised at about 1.2 or 1.3 million. Today she was moaning that it's only worth about maybe $800,000 or $900,000, which I think is actually pretty good, given that she bought it for somewhere around $170,000. And I think sometimes we don't quite keep things in perspective. You know, it would be great to have inflated values if we just sell at the very right moment. What we mostly want is for houses to be worth at least what we paid and then maybe go up 2 to 3% a year. And that's the historical average. It's what we need to get back to in this country once we figure out exactly where the bottom is.
Right. The historic versus the hysteric is what I would like to think about it as.
Oh, I love that.
In the chat room, Donald wants to know, are residential-focused REITs a good investment right now? I like REITs, actually. I find them to be very interesting as an investment. I have not been a residential focus as much as commercially focused because I think there's deeper value in buying properties at discounts now. Do you have an opinion, Jack?
Yeah, my concern is that where are the rates on REITs right now? What are they yielding? Because when REITs start to get below 4%, you're not going to see too much of a return. When they're a little bit higher, yeah, it's a great yield, and you might see some price return too.
I'm trying to look up, but I'll find that in a
But I
second.
like Jill's thinking there because, Ilyce was talking about people snapping up investment properties, and I think that's where the growth's going to be.
And speaking of which, Ilyce, I'm sorry, you go on.
I was just going to add in, so I've been getting more questions about REITs lately, and the problem that I have with REITs in general is that they do have to pass through 90% of their earnings. And there's a great website, the National Association of Real Estate Investment Trusts, NAREIT, NAREIT.org. They have great information about this. But the problem is you never really know what the managing partner is doing and the choices that they're really making. And there is so much that can be swept in as quote unquote expenses that with REITs, you're really not sure where you're left with. You know, it's like a big mutual fund of real estate portfolio holdings. So like you, Jill, I would be more inclined to go with commercial rather than somebody who owns a REIT of 10,000 or 20,000 condo units.
Right. And by the way, you mentioned the pass-through nature of a REIT, which means if you hold a REIT in a taxable account and tax rates go up, which I think most of us expect they will, this is going to be a much different kind of investment for people when they get hit with a higher tax rate, right, Jack?
Yeah, and that's one reason why you might want to think about owning them in a protected account.
Yeah.
The rules have changed a little bit to make that a little bit easier. And so I would, and MLPs are another yield vehicle that you couldn't really buy in an IRA or 401k before. Now you can. So I would definitely think about protecting that income.
Yeah, absolutely. Right. Okay, let's find out from what these people are asking here, what's on their minds. Linda wants to know, here we go, Ilyce. How can we start buying small houses, fixing them up, and selling them? Now, I know you are you're like Fred and Ethel Mertz out there of Chicago. You're a landlord. So how does somebody even consider doing this? Because it's kind of scary.
I don't want to throw, first of all, I'm going to do a little self-promotion plug and say that on Amazon, I know it never happens. On Amazon, on my little page, we just put up a series of books about real estate investing. There are 6 ebooks up there for like $2.99. You can have them all. We're almost giving them away, but Amazon requires you to charge something. But what we're finding is that people don't even realize how different this game is. There is no more buy with nothing down and you're going to finance it all and you're going to reap the profits and strip out the equity. You need 30, 35% down in cash, whatever it is you're buying, or lenders are not going to give you a loan. You're going to have no trouble getting up to 4 properties, including your primary residence. And even though Fannie and Freddie say you can go to 10, there are very few lenders that are willing to let you go to 10 properties. So you're going to have to search around and see. And then please, I did tell you 2.86% on a 5-1. You're never going to get that for investment real estate. You can really expect to be a full point above where everybody else is, if not more. And a lot of this is going to depend on where your credit is. So you need cash, you need credit, you need to be realistic, and you need, unlike my dear loving husband, Sam, you need to want to be a landlord and not just let your wife, sort of like push you into it.
Oh my God.
Wow, revealed.
Emotional there.
Now, Ilyce, can you tell, all right, we know the good part of this, which is, you have a nice levered asset, things are going great, you buy it right. Can you also talk a little bit about, because you are a landlord, the pain in the neck factor? Tell us a horror story that's going to at least maybe not scare off Linda, but at least give her what she could face as a landlady. It's not like Lucy and Ricky are living below you.
Right. I mean, so as a landlord, I have to tell you that we on the whole have been very lucky. But we have had some nightmare tenants, and these are tenants where one time they didn't speak any English. Now we got a whole year's worth of rent up front, but Sam was constantly she kept calling Sam and in broken English that she really didn't know how to speak, and we didn't know how to speak Japanese. Ask us questions and get him to come over and look at something. The toilet wasn't working. This wasn't working. That wasn't working. They were the cleanest, most lovely people, but the communication factor made it very frustrating. On the other side, we had a woman who wasn't supposed to bring in an animal, brought in a dog, and it scratched the wood floor to all heck. And even though we had an extra month in, and then when we found out, we took more money back, it cost us something like $5,000 or $6,000 to redo the floor. And in the same year, we found out that the building itself was going to issue a $25,000 special assessment per unit for a new drainage system that had been incorrectly installed when the property was built. And so in 1 year, we got hit with $30,000 worth of expenses. I will say the good news is that after 6 years, we ended up break even. We felt very, very lucky.
Right. And so, again, you have to be willing to put up with a lot of nonsense. So, again, you can pre-screen people, but it's kind of like that roommate. You never know until you get into it, right?
And just the middle of the night calls and everything else, people should not focus on the quick buck because it's a slow buck. It can be a good one, but it's a slow buck, and you have to have the right temperament to do it.
But I just want to tell you, though, about a story that I heard from one of the callers to my radio show a couple of weekends ago. The guy, he's an amazing guy. He's a consultant now, builds ships. He makes good money, but he decided in 2008, when the fourth of his 4 daughters went into foreclosure, that he should start buying some real estate. He didn't want to bail them out completely, so he did lease options with them. And in 5 years or 4 years, he has bought 68 investment properties in the greater Atlanta area, all for cash. And he now has income of something like $40,000 a month from these properties.
Wow.
So you can have both sides of it. Atlanta, one of the hardest hit areas for foreclosures. He bought a lot of his properties for anywhere from $70,000 to $125,000, and they're all positive territory. So you can have both sides of it.
That's amazing. So Jane wants to know, is there a formula for determining whether or not to purchase a rental property? In other words, the cost of house, the potential rent. What are some of the other factors that you would consider, Ilyce, before actually saying, all right, I'm going to end? But let's assume you've now made the deal with the devil. You are going to be a landlord. Talk a little bit about what are some of the variables that you should be weighing.
I think it's most important to understand what kind of unit rents in the neighborhood of choice, where you're going to rent it, how much it rents for. Some neighborhoods you want a 5-bedroom house. Some neighborhoods you're going to want a 2-bedroom condo with 2 baths. It's going to depend what's available, what you can rent it out at, and again, how much cash you have to put down and what kind of financing you're going to be able to get. I would never buy anything that wasn't cash flow positive from day one.
Now explain that for people who don't know what that means.
So that means that you're getting in from your rent more than it's costing you to own it. And by own it, I mean your mortgage, taxes, insurance, maintenance and upkeep, and on 11 months of rent, not 12, because either you're going to have some downtime, or if you have an agent who rents the property like we do. We have one of our properties in Evanston, Illinois. We rent it on a 2-year lease to incoming MBA students at Kellogg, but we pay a full month of rent to the agent who rents it for us every year. So you really have to factor in all of those little details, and do not underestimate maintenance and upkeep. In the 6 years we've owned this what was a brand new condo, we've replaced the refrigerator, we've had to have the AC work done, we've painted it once, had to polish the floors. There's maintenance that has to go on or nobody's going to want to rent it. So you can't be too conservative when you're calculating up all of those little line item expenses.
And I think what the premise of what Ilyce is saying, but didn't articulate, is that you have to think of this as an income investment. That's her point about being cash flow positive, so that it provides you with income. If it should actually appreciate in value, that's cake. That's your inflation protection and everything else. But you think of it like a dividend stock, not like an internet stock. And finally, don't expect that this pop is going to happen right away. But 20 years from now, you might realize, wow, the rent I'm charging is 6 times what it was when I bought this place. And you realize that it's really great inflation protection.
And in fact, by the way, rents are rising across the country because people can't buy houses. So, it is an interesting idea. Here's Beatrice, Jack. She wants to know, is it a good idea to sell 3 existing rental properties at a slight loss in order to use the proceeds to buy land and a home in Hawaii as a second home? I don't know anything about her situation, but I'm saying yes. No, she's saying we're going to use it as a rental for the first year to do a 1031 exchange. So the 1031 exchange is a tax maneuver that allows you to delay paying your
capital gains?
No, it's not capital gains. It's the recapture of your depreciation.
Well, it's all taxes.
Right?
It's both capital gains and it's recapture. It allows you to defer all taxes provided you meet the very strict guidelines of identifying the property in a certain number of days and closing within 180 days. And if you blow it even by a day, you blow it.
And you got to have a real estate lawyer handle it, right?
Because
right. Okay. So
not a real estate lawyer. You need a real estate lawyer, but it's a third-party company, a 1031 tax-free exchange company.
Okay, so there's got to be a third party. You got to dot all your I's, cross all your T's. Now, here's the thing, Beatrice says. And in case I need to sell the second home in 5 to 10 years, is Hawaii likely to hold its value better than states like, say, North Carolina and Las Vegas, which is where our current rental properties are? This is so interesting. So, Jack, let's go to the idea of swapping your rental for a second home.
Sure. I mean, it's really kind of apples to oranges. I like the idea. As your initial reaction was, hey, Hawaii sounds great. But I think it's a life choice. What's more important to you? From the flexibility of that Hawaii property, the fact that presumably she wants to go there and it could provide income. I like that. If she prefers the beach to the casino, it makes sense on a personal level. I do think about the fact that in Vegas you are selling a depressed asset, and I'll have to ask Ilyce, but in Hawaii I would think you're buying a fairly priced to expensive asset. So in a sense you are selling low and buying high. I'm not crazy about that. But then again, you wait until that rectifies itself and you're 10 or 20 years older. So go for it if it's what you want to do.
Now, Ilyce, what's going on in Hawaii? What do we have to know?
Hawaii had suffered along with everybody else, but there's, they're islands, right? So there's a limited amount of building that goes on there. There are a lot of restrictions and how it, goes back. Prices in Hawaii have been depressed as well. Not as depressed as Las Vegas and North Carolina. So you truly, and she's all over the box. This is exactly what I don't advise, right? When I write about investing in real estate, I talk about trying to find things that are nearby. So North Carolina sounds like a vacation property that she picked up. Las Vegas, she's got who knows where the third one is. Those markets are very disparate, and it costs more money to manage out of state. So even if she's in Las Vegas, she's managing North Carolina. Consolidating all of those and doing a 1031 tax-free exchange could be a really smart move. Over the long run, it's like the coast of California, San Francisco. It took a big dive, but it's on its way back. Hawaii's going to come back faster than Las Vegas. So your outlook, time horizon for this is really important.
And can I ask a question, Ilyce? So you do your 1031 exchange, and let's just say, for example, that Beatrice owns her primary residence. I'm just going to make it up. Her primary residence is in Washington, D.C. And now she's ready to actually retire, and she stops renting Hawaii and moves into that house as her primary residence. Okay. Now, if she stays in that house for some period of time, then it's her primary residence, and now the capital gains portion of the previous gains should be limited to that $250,000 per person. Yes or no?
No.
Okay.
So yes, I guess the answer is yes and no. So the rules have changed now, and she can move in, but when she sells, there may still be some recapture, right? Mm-hmm. There may also be a proportionate share of taxes from when the property was a rental. So if it was a rental for 3 or 4 years and then it became a primary residence, there may still be some taxes to pay on that. And I honestly, I'm not enough of a tax expert to know how Hawaii would treat it on a state level. You'd have to talk to an enrolled agent or a CPA who actually has expertise out there. But the 1031 will protect them at least till they sell that property because they won't have to pay anything. So in that case, you're protected. But once you sell, unless you're selling because it's part of an inheritance, you've died and left it in your estate, then there's a different tax treatment. And that may change also. We don't know where that's going.
Oh, wait, I have a question then. So if you really want to screw Uncle Sam, you do the 1031 exchange, you live in the house, and then when you die, what happens to that? You don't have to recapture that, no?
No, you don't have to recapture right. So, but you do get, and you do at the moment you get a stepped up basis. So yes, all that tax liability dies. That's why big landowners never sell. It's also why they pay even less in a tax rate than Mitt Romney does. So, I mean, I know people who make millions of dollars a year in their real estate and they pay nothing because of the depreciation. And that's one other thing I want to point out, and to folks who are thinking about doing this. Unless real estate is your full-time job, you're not going to be able to take the depreciation sort of on an annual basis. I think there's some sort of mistake that you're going to see that on the bottom line item for every year in your taxes. But unless this is your full-time job and you say that with the IRS, you do get the depreciation, but you get it later on. So please check with your accountant or your tax preparer so that you understand exactly what the implication is for your taxes next year. It may be different than you imagine.
Okay, Jack, this one's for you. It's a layup. Nora wants to know, can you discuss the pros and cons of cashing out a 401k to purchase your retirement home?
Interesting. On the one hand, we say, never cash out your 401k. I'm still going to say don't do it. And the reason is because your 401k you're going to need for income. So unless she's got another, a pension or some other source of regular income, maybe she's already purchased an annuity or something, I don't like that move. Now, the question is, where is she going to live in retirement? I guess it's a second home and she still owns her primary residence. Hypothetically, if she really wants to buy it now, you could raid your 401k for this purchase, sell your primary residence when you retire, maybe annuitize part of that, use that as your income stream. It's a little bit dangerous to me, though, because you've got a bunch of balls in the air, and if something goes wrong at the wrong time, you're in trouble. So I find it scary, but it's doable. And
Ilyce, you want to weigh in on this? You want to blow out the retirement funds to buy a house?
I think it's a bad move. I mean, look at all the taxes that you're going to pay to do that. I would much rather see you not have to pay the taxes, let alone penalties for anybody under the age of 59 and a half. The only thing I would say, and there are a lot of people, we talked about this earlier, tax rates are going to go up. So some people say, well, I'm cashing out at a lower tax rate. Yeah, but if you take all that money the same year, you're going to pay the highest tax rate. It may be a lot more than you would pay going forward. I'm not in favor of it. Money is so cheap right now. I would much rather you put a 10% down payment down, 20% if you can afford it, and finance the rest at, did we mention 3.87% on a 30-year fixed rate?
Unbelievable. Okay, MoneyWatch user asks, my husband and I are in our mid-50s. We owe approximately $315,000 on our mortgage. If we tried to sell the home today, it would sell for probably $45,000 less than what we paid for it. But we're not underwater on our loan, so some of their equity has been eroded. We hope to retire in about 13 years. We do not plan to stay in the house because it's just too big for us. We want to move into a retirement community where care can be transitioned from independent living to nursing care. Could you talk to my mother-in-law? We currently contribute 18 to 22% of our salaries to our retirement savings. Should we work on trying to pay off the mortgage, or would we be better off taking extra money we have and put it into our retirement savings? Jack, what would you like to do?
One of my favorites. Did she say how many years are left on this $315
No, but
mortgage?
let's just say that because she says they want to retire in 13 years, let's call it 15 years,
Sure.
Just for the heck of it.
So the reason you sent this to me is probably because of the academic study that I love to trot out, where one guy, it was a guy in the Fed and then a couple of professors at the University of Texas looked at this. They ran the numbers and found that you're better off continuing to put the money into your 401k rather than paying off the mortgage early. And the reason is primarily because that 401k money is pre-tax. So for every buck you get from your employer, it bypasses Uncle Sam, and 100 cents goes in that 401k, plus you got your match, so call it $1.50 for every dollar you earn. Whereas if you take that money as pay and then pay off your mortgage, you're actually only putting 70 cents on the dollar roughly towards your mortgage. So better off putting in the 401k, keep that mortgage on the $315,000 on a glide path. I'd like to see you pay that off by the time you retire. So maybe we're throwing in one extra payment a year or whatever it takes so that you pay it off in time for retirement, but I wouldn't pay it down too fast. Also, as Jill talks about all the time, you want that cash flow. So let's say something bad happens. You know you've still got the cash, and maybe you don't put in your 401k, you pay a medical expense or something else.
Ilyce, what do you feel if somebody does want to move into one of these STEP facilities and they know they are going to move? Should they be saving their shekels to pay for those maintenance fees? I mean, what's your feeling around this?
That kind of move is really expensive. And some of the properties, the better properties, they take a huge upfront fee, which you then get returned to you in some part, large or small, after you exit the facility on a permanent basis. Feet first, usually. But I think they're very expensive, and it's only getting more expensive. If you look at the costs of long-term care insurance and what people are paying for nursing home care, or what they're paying for these kinds of transitioning lifestyles, $4,000 and $5,000 a month for a 1 or 2 bedroom place is not unheard of. And that's just a huge amount of money. You're going to need more shekels. So I'm kind of with Jack on this idea that you pump as much money as you can into savings. Now, the only thing I would say that's a little different is if they have $315,000 left, and let's say they have 24 years left on the mortgage, which you could possibly have, I could see them refinancing with the existing balance into a 15-year loan. That'll get them really close to paid off by the time they get out of Dodge in 13 years.
Okay.
And I could see that they may even be able to shave those extra 2 years off because now they've paid in so much of that money and they've got a smaller balance than when they started. So when they start the clock ticking again, it's a 15-year at 3.25 or 3.1875, which is such a low number. I could see them paying the same or even a little bit more every month, but now they've cut, and this is where it comes back again, they've cut 7, 8, 9 years off of their loan. That, I think, is a really smart move, and it will save them tens of thousands of dollars, money that they could much better spend for savings, and then they're really ready to go in 13 or 15 years.
Yeah, absolutely. Jeff writes that he's trying to decide should he sell or rent his condo in Queens near JFK. I guess he's trying to, maybe this would be good if you were a flight attendant. Yeah. You could rent his apartment. It's 1,100 square feet, 2 bedrooms, good condition. It's in a big complex. So, Jack, to sell or to rent? He doesn't tell us a lot of details about this, but let's make up some details anyway. Let's assume that he can rent and cover his nut.
Sure. And we should stipulate, if he can't, then the answer is easy, sell.
Okay. So now let's say that he can. Let's say that he can make a couple extra bucks.
Yep.
What do you think about renting out this space and he obviously doesn't need the cash out of it, but he goes and rents another place. What do you think?
Well, I think it comes down to what Ilyce was saying before. If you want to be a landlord, if you have the stomach for that, it's a pretty good investment. It's an income investment, which is nice. It covers you for inflation, which is nice. If you've got, I don't know, say stocks and bonds or your other assets, this is a nice way to diversify. So I like all that. And yeah, flight attendant's a good idea. Keep in mind, when you rent to a flight attendant, you are actually renting to about 17 flight attendants who share it as they come in and out of town. So make sure that, you know, a fraternity and sorority house for slightly older people is what you really want to get yourself into there. So it all comes down to your personality. I think it's a good investment if you have the stomach for it and you can cover your nut. Otherwise, liquidate and put it in something that you can go to bed at night not worrying about.
Ilyce, Dennis wants to know, he just bought a rental home. He wants to know how to handle this on his income taxes. First of all, if you've never had rental property, does it make sense to hire a CPA for that first year of tax returns?
You know, unless you're really adept at using Mac and Tax or TurboTax, I would say the answer is yes. Again, buying real estate definitely is going to have an impact on how your taxes get calculated. There's the whole issue of depreciation. There's the issue of how are you going to be able to take that? Do you have any kinds of similar like income that you can offset? So I think it's a good idea. It's not a lot of money. You would be well advised to have somebody in the accounting space, whether it's a CPA or an enrolled agent. I'm a big fan of enrolled agents. Have somebody on your side to take a look at it and kind of get you prepped for your first year and teach you how to think about it.
And Dennis also wants to know about setting the rental rate. I imagine that, he's got to go out and find out what's going on in the neighborhood. But
Sure.
I mean, that's easy and readily available information. What about setting the rent a little bit lower for the first year just to get somebody in there who, like someone said to me recently, you know what? I rented at a slightly under market because I knew the person going in and I felt much more comfortable trying to, instead of squeezing out $300 more a month, I felt better knowing I know this person, I know her parents, they're not, she's not going to really screw me. So she felt more comfortable in renting that way. Is that a plausible line of reasoning?
It's just what Sam did. So we have another property in downtown Chicago that we were getting ready to rent after a number of years of doing something else with it. And he went downstairs and he looked on the board where everybody posts their apartments for rent. He kind of saw what everybody was renting at, typically around $1,800 a month, and he priced it at $1,650 and basically got 3 people in the door the first day. We avoided paying a realtor to list it. And it's people who live in the building, want to stay in the building, but their unit is being sold. And August 1st, they're going to be moving in. So it made a very smooth transition. And honestly, for the extra $150 a month, there was, we don't pay the expense of the realtor. We don't wonder whether or not we're going to find somebody. All Sam has to do is just get our stuff cleared out and get, guy into paint and patch the walls and buff the floors a little bit. And we're good to go. And I think they even took a 2-year lease. So you really feel like it's going to go well. I have lots of stories like that in my arsenal. I was in Oakland, California, visiting my cousins with that house I told you about. They have done that every year for 20 years, where they price it slightly below the market. 100 people apply to live there, and then they fight over who's going to fix up the property enough so that they get chosen. And that is how they've never had a month where it wasn't rented in 20 years. The parents of these kids pay to have it painted and patched and fixed up and all kinds of stuff done to it. Is a great strategy.
All right. Okay, so we've got the last question from Sue, who wants our opinion regarding a short sale on her home loan. Now, this is a complicated story. Megan and I were talking about it before. We had to kind of parse it through. So she tried to do a short sale through the bank and didn't work out. But then she finds out that the bank has agreed to accept a much lower amount for the house than she suspected, I guess, in a foreclosure is what I imagine. Then she says, if they're going to take that little amount of money, she could take a bunch of money out of her retirement account, and she herself could have actually owned the house for that price. So what she's wants to understand. This is what she's saying. She's like, so let's play the numbers for a second. Let's pretend that, she's got a $500,000 house and she owes a whole bunch of money on it. And they say, you owe $500,000. We'll take that. Thank you very much. You're not paying on it. But then they go and accept $320 for the house. And she wants to know, why can't I just get the write down of my principal and give them the difference if that's what they're willing to accept? Ilyce, is there any bargaining in this, or at least offer of negotiation here?
They will never, if she wants to stay in the house, there are very few lenders that are doing principal reductions. If she can afford to make the payments, why would they accept less from her? She's the one who's screwing them. Right. She signed the loan. They're never going to let her or anybody else that she's married to or her children or whatever buy that house at 3.25. It's going to go to somebody else. And she has to understand that is the problem with what's going on out there, that she is missing a huge chunk, $150,000 that she owes the bank. They're not just going to give that to her simply for whatever. I'm not even sure what she's really thinking, but I get a lot of questions like this. So if she wants to do a short sale and the bank has agreed to a price and she can get rid of the house, what the bank will do for her is now they are doing cash for keys. So they'll give her some sort of a check to move and make sure it's in good shape. They will wipe out her debt forever, meaning that if she goes, she will not have to pay the IRS for phantom income. They're never going to chase her for the missing $150,000. She's going to take a big hit to her credit. She'll get to move on with her life. That's what she gets. Now, if she has the money to keep paying the mortgage, then she pays the mortgage. And this doesn't have to happen, but she doesn't get to have it both ways. And people are confused by this.
Right. I understand that. I'm sure she does now, since you just whipped her into shape. God love you, Ilyce. Hey, I have a question for you. So her credit's trashed. Let's assume she's got a good job. how long will it be before you think, and again, nothing else bad on her report, just this one blemish, no
Sure.
credit cards, no nothing, pays all of her bills. She does the short sale. How many years before you think she can boost that credit back to where it was before the event?
Well, actually, FICO on its blog did a survey and looked at it. Her credit score with a short sale where everything else is good, let's assume she was like at 800. And with the short sale, it fell to about 625, maybe even 575.
Okay.
Within probably 5 years, she'll be able to get close to that. She probably won't be at 800, but she'll be in the 700 range. But the real question is, when can she buy another house? And this is so interesting, Jill. When all this came down, Fannie and Freddie and FHA said, short sales, we're not going to look at you for 3 years. Foreclosures, we're not going to look at you or allow you to buy a house for 5 years. But I am hearing about people with short sales and foreclosures who are buying within a year or two.
Whoa.
So that draconian look, I mean, the banks have sort of said, hey, guys, if we take all these people and put them in the penalty box for 3 to 5 years, we're going to have a problem. So we don't really want to do that. That is the number to watch, how long it's going to take her to buy another house. And I would say probably within a year or two, she'll be able to figure out a way to do it.
That's awesome.
Wow.
That's really awesome. Okay, wait, I lied. There's one last question because this is a good one. Mike wants to know, he wants to get specific housing price change information predictions for targeted suburban areas. In his case, a targeted suburban area in Portland, Oregon. And wants to know, is that available? Is there an Oregon, detailed report on what's going on, economically in Oregon, or do you know of anything like that?
What do you think his end goal is? Is to find out what housing prices are all over neighborhoods?
He wants to know. He wants to basically get information like house price change information and predictions for the next 5 to 10 years. My guess is he's trying to figure out whether to stay in his house or sell it.
Oh, I was going to say we got a future Donald Trump here who wants to invest.
Or he could be an investor, either one. But are these really worth anything anyway?
I don't think so. I think you can get some good information from a place like blockshopper.com, which is a former Tribune Interactive guy went out and started a website that literally you can type in an address and Block Shopper will tell you what all the other houses are selling for. But in terms of going forward, I think what you want to do is identify some neighborhoods, and then you want to go have conversations with real estate agents, somebody like my mother who's been in the business for 30 years and can tell you how these homes come on and off the market and what's really going on from a trend perspective. That to me is much more valuable than any sort of report that you might pay for. You got to go do the work. And once you do, I think you'll find what you're looking for.
Shoe leather reporting, Jack.
Yeah, exactly. Jimmy Breslin going out there.
And you know what? Our favorite economist, Mark Toma, always says, don't ever trust economist predictions that are farther than 6 months out.
Exactly. And you have to be careful with realtors, too. As Ilyce knows, there are a few people more optimistic than real estate professionals. So you do have to be a little bit careful there and just sort of take it with a grain of salt, talk to a number of people, see what the trend is. Also, you can go to Zillow and look around. They don't always nail it, but it's one more input. I think the more inputs he can get, the more likely he is to get something useful. But I hope he's not using this to try to time the market and figure out where to buy investments.
No one would ever do such a thing. Ilyce Glink, she is just rosy today. She is ebullient in her outlook, which is so lovely to see after 3 years of you bashing our heads in saying things are horrible. Just FYI, okay? So Ilyce Glink, please follow her on Twitter, which I think are you at Glink?
I am at Glink every day.
Okay, and at Glink, and you can follow Ilyce's blog, which is Home Equity on MoneyWatch, and you can go to thinkglink.com. Is that your favorite one these days?
I like it. I'm really, since so many people are interested in investing, I'm going to do that little plug again and say, go to my Amazon page, just type in Ilyce Glink and take a look at the ebooks that we have, because there are 6 of them about investing in real estate for $2.99.
Sweet. All right, Ilyce, thank you so much for joining us. Always a font of information about the markets.
I think that we should start the Glink leading indicator.
Oh, I like that.
Yeah.
Glink leading indicator, like it.
It would be just whether she's smiling when she comes on, because sometimes she is grimacing a little bit.
Yeah.
There are times where you've come on and you've been a little bit anxious. So I think that it's delightful to see you a little bit more upbeat. And I know it's just this month. We could all turn around next week. I don't want to hold you to it, but we're happy to take it.
I'm feeling good. Jill, I am feeling much better than I was a couple of years ago. Things
She's
are looking
not a day
better.
trader.
She is not.
No, she's long-term. Yeah.
She's long-term trend. Jack Otter. By the way, Megan is just telling me that hot off the news here, Facebook is now talking about delisting from NASDAQ and moving on to the New York Stock Exchange.
Oh, ouch.
So,
Ouch.
FYI, I bet the NYSE would have liked that offering, but, you know.
So what would the ticker be? Because would they have to lengthen it?
I don't know if they would. I think that no, I don't think they would. They could probably keep the ticker because the ticker would have to be sort of freed up for all exchanges, right? It
Yeah,
wouldn't be,
I
right?
see. That's true, yeah.
So, in fact,
be
it's
FBMZ or something.
no, it would be actually more. I was surprised it was FB on the NASDAQ. You know, I'm used to the four-letter symbols on the
it's the same
NASDAQ.
thing, yeah.
That said, we don't know if this is true or not, but we love talking about Facebook so much. I'm so bored. Thank you all for watching, Jack. Another Fabu show.
It was, yeah.
Next week, we've got an exciting guest. Do you know who that is?
I don't yet know who it is, no.
Is it Lizanne? Lizanne
that's right.
Saunders.
Oh, sure, from Schwab.
So we're going to be doing super investment questions. So get your investment questions ready. Get your economic outlook ready.
And I'm going to make a plug for Lizanne Saunders. In April of 2009, I heard her speak, and she predicted that the recession had officially ended and things were going to improve. This was right before I got the job here, so I was briefly working as a freelancer. I pitched the story around, hey, Lizanne Saunders says the recession is over. It was so crazy an idea in the depths of the gloom at that point that nobody would actually take me on that story. Nobody was willing to write that story. She was right, so let's see what she says next week.
All right, we will, and we will be talking about that with you and with her. Tune in to Ask the Experts, and if you've got a question, shoot us an email, and it is asktheexperts@moneywatch.com. I'm Jill Schlesinger.
I'm Jack Otter.
She's Ilyce Glink over there, and we want to thank her again for joining us, and thank you for watching. We'll see you next week.